Something has shifted in the way the financial system moves, but it has done so without noise. The change is not visible in the places people are trained to look, and it does not announce itself through volatility or panic. It appears instead in the spaces between transactions, in the hesitations of institutions, and in the way money quietly refuses to flow where it once moved freely. Most observers continue to believe that stability means normality, that as long as markets open and currencies trade, the system remains intact. What is being missed is that systems do not break by stopping. They break by losing internal coherence. The machinery can still turn while its structural logic begins to unwind. Capital still circulates, but it is no longer behaving as if it trusts the pathways through which it moves. It pauses where it used to accelerate, and it seeks shelter where it once sought growth. This is not a sudden reversal, but a gradual withdrawal from exposure. When this kind of shift occurs, it does not appear in headlines because it does not produce immediate disruption. It appears in the behavior of large institutions that begin to change how they hold reserves, how they extend credit, and how they measure risk. Those choices rarely make noise, but they quietly reshape the terrain. Central banks are often described as reactive, responding to inflation, employment, or financial instability. In reality, they are also deeply sensitive to the internal state of the system they manage. When they sense strain, their behavior changes in subtle but consistent ways. Those changes are now visible to anyone who knows how to read them. Not in announcements, but in the structure of their balance sheets, the types of assets they prefer, and the way they interact with markets behind closed doors. These signals are not meant for public interpretation, yet they reveal more than any press statement ever could. What makes this moment unusual is not that pressure exists, but that it is being managed rather than resolved. Liquidity is being guided, not expanded. Risk is being redistributed, not eliminated. Stability is being preserved in form while its substance grows thinner. Most people do not notice this because the surface still looks calm, prices still move, institutions still operate, and money still changes hands. Yet beneath that motion, something has lost alignment. This is how dislocation begins, not with collapse, but with quiet divergence between how the system looks and how it feels to those who operate within it. Central banks are responding to that divergence now, even if they do not say so directly. The question is not whether something has changed. It is whether enough people will recognize that change before it becomes impossible to ignore. This moment cannot be understood by comparing it to the cycles people have grown accustomed to. In previous periods of economic stress, the system still retained a degree of internal flexibility. Interest rates could be adjusted, credit could be expanded, and growth could eventually absorb excesses. That flexibility has now been substantially eroded. Over the past several decades, the global financial system has been built on a foundation of continuously rising leverage. Sovereign governments, corporations, and households have all become structurally dependent on low-cost credit. In the early 2000s, total global debt stood at roughly 2 times world economic output. After the financial crisis and the wave of stimulus that followed, that ratio climbed far beyond what organic growth could support. What matters is not the exact number, but the relationship between debt and productive capacity. That relationship has become increasingly strained. Central banks stepped into this imbalance by providing liquidity on a scale never previously attempted. Balance sheets expanded dramatically after 2008, not as a temporary measure, but as a new operating model. These interventions stabilized markets, but they also changed their character. Financial assets no longer reflected only economic fundamentals. They began to reflect policy expectations. That shift is crucial. When markets become conditioned to monetary support, they become less resilient. Volatility is suppressed, but risk accumulates beneath the surface. The system begins to depend on constant reassurance rather than on organic stability. At the same time, globalization created intricate financial linkages that magnified this dependency. Capital flows now move across borders in response to marginal differences in yield, regulation, or currency risk. This makes the system efficient, but also fragile. A policy adjustment in one major economy can propagate through multiple markets almost instantly. What makes the present moment different is that central banks are now managing not just their own domestic conditions, but a globally interconnected balance sheet. Their actions must account for how liquidity moves through international banking systems, shadow finance, and derivative markets. This complexity did not exist to the same degree in earlier cycles. There's also a growing tension between monetary policy and fiscal reality. Governments rely on low borrowing costs to sustain spending, yet low rates undermine currency stability over time. Central banks find themselves caught between supporting sovereign debt and preserving the credibility of money itself. This creates a form of policy exhaustion. Tools that once delivered powerful effects now produce diminishing returns. Rate cuts stimulate less activity. Asset purchases generate less confidence. The system requires ever larger interventions to achieve the same stabilizing impact. Institutional behavior reflects this exhaustion. banks have become more cautious in extending credit. Pension funds and insurers struggle to meet long-term obligations in a low-yield environment. Even central banks increasingly rely on communication strategies rather than decisive action. All of this signals that the system is operating closer to its structural limits than at any time in recent memory. It is not in crisis, but it is no longer comfortably stable. That distinction is subtle, yet it defines why this period cannot be compared to what came before. The difference lies not in the presence of risk, but in the system's reduced ability to absorb it. When central bank behavior begins to change quietly, history shows that it is rarely arbitrary. These shifts tend to emerge during periods when the underlying structure of the monetary system is under strain, even if that strain has not yet produced visible instability. By examining earlier episodes where similar dynamics unfolded, it becomes possible to see how today's signals fit into a longer pattern. One of the most instructive precedents emerged during the final years of the Bretton Woods monetary system. In the decades after World War II, the global economy operated under an arrangement in which the US dollar was convertible into gold and other currencies were pegged to the dollar. On the surface, this structure appeared stable. Trade expanded, growth was strong, and financial markets operated with a sense of order. Yet beneath that stability, imbalances were quietly accumulating. The United States began running persistent fiscal and trade deficits, which meant that more dollars were circulating outside its borders than could be credibly backed by its gold reserves. Central banks in Europe and elsewhere noticed this long before the public did. Rather than making dramatic statements, they began to adjust their reserve management practices. Dollars were increasingly exchanged for gold, not because of panic, but because of prudence. The official rhetoric of cooperation remained intact, but the behavior of capital signaled eroding confidence in the system's long-term viability. By the time the gold window was eventually closed, the decision merely formalized a reality that had already been reflected in central bank actions for years. A similar pattern appeared during the inflationary period of the 1970s. Governments and monetary authorities struggled to reconcile expansive fiscal policy with the need to maintain currency stability. Officially, inflation was framed as a temporary problem. In practice, central banks were forced to tolerate rising prices because tightening too aggressively risked destabilizing heavily indebted economies. Capital responded by seeking refuge in assets that could not be easily debased. Precious metals, real estate, and hard commodities all reflected this quiet migration of trust away from paper claims. Once again, the key signal was not volatility, but repositioning. The late 1990s and early 2000s offer another useful reference. Following a series of emerging market crises and currency collapses, many countries began accumulating large foreign exchange reserves. This was not driven by optimism, but by a desire for self-insurance. Central banks, particularly in Asia, had learned that access to global liquidity could not be taken for granted. By holding large dollar reserves, they sought to protect themselves against external shocks. This behavior reshaped global capital flows and contributed to persistent imbalances, including the buildup of debt in advanced economies. The global financial crisis of 2008 revealed how deeply these imbalances had penetrated the system. When interbank lending froze and major institutions faced insolvency, central banks responded with unprecedented coordination. Swap lines were established between major monetary authorities to ensure that dollars could flow where they were needed. Balance sheets expanded dramatically through asset purchases designed to stabilize markets. What is often overlooked is that these actions were not primarily about growth. They were about preserving trust in the system's ability to function. In the years that followed, this emergency framework became normalized. Quantitative easing, once considered extraordinary, became a routine tool. Interest rates were held near zero for extended periods, not because conditions were ideal, but because the system could not tolerate tighter financial conditions. The message was subtle but consistent. Stability had become dependent on intervention. What links all of these periods is not crisis itself, but the way institutions behaved in anticipation of it. Central banks adjusted reserve compositions, altered liquidity provision, and coordinated behind the scenes long before markets fully recognized the underlying stress. Confidence eroded gradually, expressed not through panic, but through precaution. Today's environment exhibits many of these same characteristics. The system still operates, but it does so under a growing web of safeguards. Liquidity facilities, regulatory accommodations, and coordinated policies are all signs of a structure that requires constant support. These are not signs of imminent collapse. They are signs of a system that no longer relies on its own internal resilience. History suggests that when central bank behavior becomes more cautious, more synchronized, and more focused on risk containment, it is responding to pressures that have already begun to accumulate. The visible consequences tend to arrive later. The signals are present first, embedded in the quiet decisions of institutions tasked with holding the system together. The dominant signal shaping central bank behavior in the current environment is liquidity strain, not in the sense of an outright shortage of money, but in the sense that usable liquidity has become increasingly conditional. Financial systems can possess large quantities of currency and credit while still experiencing functional scarcity. What matters is not how much liquidity exists in aggregate, but how freely it moves through the network of institutions, markets, and obligations that depend on it. In earlier decades, liquidity flowed with relatively little friction. Banks lent to one another, markets absorbed risk, and central bank policy operated as a background stabilizer. That structure relied on mutual confidence between counterparties. When one institution extended credit, it did so believing that others would honor their commitments. As leverage has grown and balance sheets have become more complex, that trust is thinned. This is why modern liquidity stress rarely announces itself as a sudden freeze. Instead, it appears as a gradual tightening of conditions. Funding becomes more expensive in certain corners of the market. Collateral requirements increase. Institutions become more selective about whom they will transact with. Each of these changes is small on its own, but together they alter the entire flow of capital. Central banks have adapted to this environment by moving from indirect to direct liquidity management. In the past, adjusting short-term interest rates was often enough to influence lending and borrowing across the system. Today, that mechanism is weaker. Policy rates no longer transmit evenly because financial structures are layered with regulations, capital buffers, and risk models that mediate how money moves. To compensate, central banks now rely on targeted facilities, asset purchases, and emergency backstops. These tools are designed to ensure that key markets continue to function even when private confidence fades. During the global financial crisis, for example, the Federal Reserve AS balance sheet expanded from under $1 trillion to more than $2 trillion in a matter of months. After subsequent rounds of quantitative easing, it would grow to several times that size. Those figures matter not because of their magnitude, but because they reflect how deeply central banks became embedded in market functioning. This embeddedness creates a feedback loop. Markets come to expect intervention, which encourages risk-taking. That risk-taking increases the system's dependence on continued support. Over time, liquidity becomes less a natural property of the market and more a managed resource. Debt saturation amplifies this effect. When governments, corporations, and households carry large debt loads, they become sensitive to even small changes in funding conditions. Servicing costs rise quickly when liquidity tightens, which can trigger defaults or forced deleveraging. Central banks are aware of this vulnerability, which is why they often act preemptively to ease conditions. Yet easing also has consequences. It can weaken currencies, distort asset prices, and encourage further borrowing. This is the central tension of the current era. Liquidity must be provided to maintain stability, but excessive provision undermines the long-term credibility of money itself. Trust decay is the final component of this signal. As financial structures grow more complex and intervention becomes more frequent, participants begin to question the reliability of the system's rules. Markets start to trade on policy expectations rather than on economic fundamentals. When that happens, confidence becomes fragile because it depends on continued reassurance. Central banks are responding to this by attempting to project control. They use forward guidance, stress tests, and regulatory oversight to shape behavior. These measures can stabilize conditions in the short term, but they also reveal how much effort is required to maintain equilibrium. The primary monetary signal, then, is not simply that liquidity is tight or abundant. It is that liquidity has become something that must be constantly engineered. That is a profound shift from earlier eras, when the system could rely more heavily on its own internal balance. The primary signal of liquidity strain does not operate in isolation. It is confirmed and reinforced by a network of secondary signals that appear across different segments of the financial system. These signals are subtle, but when viewed together, they provide a coherent picture of how stress propagates beneath the surface of markets. Bond markets are one of the most sensitive indicators. Government debt is often described as the safest asset in the financial system. Yet its behavior reveals much about underlying confidence. When investors demand higher yields to hold long-term bonds, it suggests uncertainty about inflation, fiscal stability, or the future value of currency. Central banks closely monitor these movements because bond markets anchor everything from mortgage rates to corporate borrowing costs. When yields rise in ways that threaten financial stability, intervention becomes more likely. The fact that such interventions have become more frequent over time reflects the growing fragility of the system. At the same time, the shape of yield curves offers additional insight. In a healthy environment, longer-term debt carries higher yields than short-term debt, reflecting the time value of money and inflation risk. When that relationship distorts, it indicates that investors are more concerned about near-term stability than about long-term growth. Central banks often respond to these distortions by adjusting their asset purchases or policy guidance, not to signal optimism, but to prevent disorderly repricing. Currency markets provide another layer of confirmation. Exchange rates are influenced by trade flows, interest differentials, and capital movement. When currencies begin to fluctuate in ways that cannot be explained by these factors alone, it suggests that capital is shifting based on perceived safety. In periods of systemic stress, money tends to move toward currencies backed by strong institutions and deep markets, even if their economic fundamentals are imperfect. This behavior reveals that trust, not yield, becomes the primary driver. Central banks attempt to moderate these movements through coordinated policy and communication. Swap lines between major monetary authorities are one example. They allow dollars, euros, and other key currencies to be provided where they are needed, preventing shortages that could destabilize global finance. The existence and expansion of these arrangements indicate that authorities are preparing for stress, not because they expect immediate crisis, but because they recognize how quickly confidence can erode. Precious metals, particularly gold and silver, offer a third form of confirmation. These assets do not generate income and do not depend on the creditworthiness of an issuer. When demand for them rises relative to financial assets, it reflects a preference for security over return. This shift often occurs quietly through changes in central bank reserves, exchange-traded products, and physical accumulation. After the global financial crisis, central banks collectively increased their gold holdings. This was not a speculative move. It was a strategic adjustment, reflecting a desire to diversify away from currencies that were being created in large quantities. Silver, though less prominent in official reserves, has historically mirrored this behavior in private markets, where it serves as a hedge against monetary uncertainty. Credit markets also provide important signals. When spreads between safe and risky debt widen, it indicates that lenders are becoming more cautious. Companies with weaker balance sheets face higher borrowing costs, which can slow investment and growth. Central banks watch these spreads because they reveal how risk is being priced. If spreads widen too far, it can trigger a contraction in credit that feeds back into the real economy. These secondary signals interact with one another. A rise in bond yields can affect currencies. Currency volatility can influence commodity prices. Changes in credit conditions can alter investment flows. Central banks are constantly monitoring these relationships, adjusting their policies to prevent feedback loops from becoming destabilizing. What is notable in the current environment is not the presence of any single warning sign, but the persistence of many. None of them on their own indicate crisis. Together, they suggest a system that requires careful management to remain balanced. The confirmation signals do not point to collapse. They point to sensitivity. The financial system has become more responsive to small changes in confidence, liquidity, and policy. That sensitivity is the defining feature of the era central banks are now navigating. Silver occupies a distinctive position within the financial system because it exists at the intersection of industry and money. Unlike purely monetary metals, it is consumed in manufacturing, technology, and energy infrastructure, while also being held as a store of value. This dual role makes it an unusually sensitive indicator of systemic stress. When financial confidence weakens, silver does not respond in a linear way. It often remains suppressed for long periods before adjusting suddenly, reflecting the tension between paper markets and physical demand. Historically, silver has spent extended stretches trading within narrow ranges even as monetary pressure builds. This is partly due to the structure of modern commodity markets, where futures contracts and derivative instruments allow large volumes of synthetic supply to influence price discovery. These paper markets can absorb speculative demand and delay the signal that would otherwise emerge from tightening physical availability. During periods of monetary strain, this mechanism acts as a kind of buffer, preventing silver from immediately reflecting deeper instability. Yet this suppression has limits. When trust in financial assets erodes, the demand for tangible stores of value increases. In the late 1970s, as inflation accelerated and confidence in fiat currencies declined, silver's behavior shifted abruptly. It moved from relative stability to rapid repricing, not because of a change in industrial demand, but because investors began to view it as a form of monetary insurance. A similar pattern appeared in the aftermath of the 2008 crisis, when expansive central bank policies led to renewed interest in hard assets. These episodes demonstrate an important dynamic. Silver does not lead during the early stages of financial stress. It lags. For a time, it can even appear disconnected from underlying conditions. This delay often leads observers to conclude that the metal is irrelevant or outdated. In reality, it is accumulating pressure within a market structure that is designed to smooth volatility. Gold, by contrast, tends to respond more quickly to changes in monetary confidence. It is held by central banks, traded in large volumes, and widely recognized as a reserve asset. Silver, with its smaller market and greater industrial exposure, behaves differently. It remains anchored by industrial pricing until monetary demand overwhelms that anchor. When that happens, the adjustment is rarely gradual. Hard assets in general share this characteristic. They are slow to reflect stress while financial markets remain orderly. Real estate, commodities, and precious metals can all remain subdued even as debt expands and liquidity becomes more fragile. Once confidence begins to shift, however, These assets often reprice as capital seeks forms of value that are not dependent on the solvency of issuers or the stability of financial intermediaries. Central bank behavior indirectly influences this process. When monetary authorities expand balance sheets, lower interest rates, or provide targeted liquidity, they are attempting to stabilize the financial system. These actions can delay the migration of capital into hard assets by sustaining confidence in paper claims. However, they also increase the long-term supply of currency, which eventually raises questions about purchasing power. This tension is why silver and similar assets are best understood as indicators of trust. They do not rise simply because inflation exists. They rise when holders of financial assets begin to doubt the durability of monetary arrangements. That doubt does not appear all at once. It grows quietly, reflected in portfolio allocations, reserve management, and physical accumulation. In recent decades, the infrastructure of precious metal markets has become more complex. Exchange-traded products, unallocated accounts, and derivative contracts allow investors to gain exposure without taking delivery. This increases liquidity, but also creates layers of claims on the same underlying metal. During periods of stability, this structure works smoothly. During periods of stress, it can amplify pressure as participants seek to convert paper exposure into physical possession. The behavior of silver under such conditions is therefore not just a function of supply and demand. It is a function of confidence in financial intermediation. When that confidence is high, the metal remains quietly priced. When it weakens, the latent tension between paper and physical markets becomes visible. This makes silver a delayed but powerful signal. It does not predict crisis. It reflects the cumulative weight of mon. When financial systems operate under prolonged strain, the most important changes occur not in markets, but in the psychology of the institutions that manage them. Central banks, governments, and large financial actors are acutely aware of the fragility that develops when debt, leverage, and policy intervention accumulate over time. The responses to that awareness are subtle, deliberate, and often designed to preserve confidence rather than to confront structural limitations directly. Central banks, in particular, become guardians not only of monetary stability, but of narrative stability. Their communications are carefully calibrated to reassure markets that conditions are under control. Forward guidance, projections, and official statements emphasize continuity and gradualism. Yet, behind that messaging, policy frameworks are continuously adjusted to account for rising risks. Liquidity facilities are expanded, collateral rules are modified, and regulatory constraints are quietly eased. These actions reveal an institution preparing for stress, even as it speaks of stability. Governments exhibit a similar duality. Fiscal authorities rely on continued access to credit markets to fund operations and social commitments. As debt levels rise, maintaining investor confidence becomes paramount. This often leads to policy choices that prioritize short-term stability over long-term sustainability. Spending is maintained, deficits are tolerated, and structural reforms are deferred. The political imperative is to avoid disruption, even if that means postponing necessary adjustment. Investors, particularly large institutional ones, respond to this environment by becoming more defensive. Pension funds, insurance companies, and sovereign wealth funds are tasked with preserving capital over long horizons. When yields are low and volatility is suppressed, they search for return in increasingly complex instruments. Yet as systemic pressure grows, these same institutions begin to reduce exposure to riskier assets and increase allocations to liquidity and hard assets. This shift is rarely announced. It is reflected in portfolio rebalancing and reserve accumulation. The psychological effect of prolonged intervention is a form of learned dependency. Markets become conditioned to expect central bank support whenever volatility rises. This creates a feedback loop in which risk-taking increases during calm periods, knowing that policy will likely respond if conditions deteriorate. Over time, this erodes the market's ability to self-correct. At the same time, there's a growing undercurrent of unease. Financial professionals are aware that the tools used to stabilize the system are becoming less effective. Each round of easing produces a smaller impact on growth. Each policy announcement requires greater emphasis to achieve the same calming effect. This diminishing return on intervention contributes to a sense that the system is being managed rather than healed. Narrative control becomes increasingly important in this context. Central banks and governments emphasize resilience, adaptability, and innovation. They frame policy actions as proactive rather than reactive. This is not necessarily deceptive. It is a reflection of the need to maintain public confidence in institutions that underpin the monetary system. Yet, narrative control also has limits. When discrepancies between official messages and lived economic experience become too wide, trust begins to erode. Households may see rising costs of living. Businesses may face tighter credit conditions. Investors may encounter unexpected volatility. These experiences slowly chip away at the belief that the system is stable. Institutional behavior adapts to this erosion of trust. Regulations become more stringent in some areas and more flexible in others. Capital requirements are adjusted. Stress tests are conducted. These measures are designed to reassure both regulators and markets that the system can withstand shocks. However, their very existence signals an awareness of vulnerability. The psychological state of the system thus becomes one of managed anxiety. Authorities are not panicked, but they are not complacent either. They operate in a space where stability must be actively maintained through coordination, communication, and constant adjustment. This environment also affects how new risks are perceived. Innovations in finance, technology, and geopolitics introduce uncertainties that must be absorbed by an already stretched system. Central banks and governments respond by incorporating these risks into their frameworks, often expanding their mandates in the process. This further entangles monetary policy with broader economic and political objectives. For investors and institutions, this creates a landscape where signals matter more than ever. Traditional indicators of health, such as growth rates or employment figures, are less informative when policy intervention is pervasive. Instead, attention shifts to how authorities behave under pressure. Do they prioritize liquidity? Do they tolerate inflation? Do they intervene in markets more frequently? These behavioral cues become the true indicators of systemic condition. They reveal how much stress the system can bear before its managers feel compelled to act. What is unfolding now is not a breakdown of confidence, but a gradual recalibration of it. Institutions are adjusting their expectations, their strategies, and their narratives to reflect a world in which stability is no longer automatic. That psychological shift is as significant as any economic statistic, because it shapes how decisions are made across the entire financial landscape. When the signals described throughout this narrative remain unresolved, their impact tends to spread gradually across the structure of the financial system. The consequences are rarely sudden, and they do not arrive in a single dramatic moment. Instead, they accumulate through a series of subtle adjustments in how capital moves, how risk is priced, and how institutions interact with one another. One of the first effects is an increase in financial friction. Transactions that once occurred easily begin to require more collateral, more documentation, and more scrutiny. Banks become more selective in extending credit. Market participants demand greater compensation for risk. These changes do not halt activity, but they slow it, introducing inefficiencies that weigh on growth. Volatility also becomes more persistent, not necessarily in the form of sharp crashes, but in the form of repeated, uneven swings across asset classes. As liquidity becomes more conditional, prices react more strongly to marginal shifts in confidence. Small pieces of news or policy adjustments can produce outsized market responses because the system is operating with less internal buffer. Over time, this environment encourages a reordering of capital. Investors begin to favor assets and institutions perceived as more resilient. This can mean a shift toward larger banks, more liquid markets, and currencies backed by strong central banks. At the same time, capital flows away from weaker structures, creating divergence between regions, sectors, and financial instruments. This divergence can strain political and economic relationships. Countries that depend on external financing may face higher borrowing costs. Corporations with fragile balance sheets may struggle to roll over debt. These pressures can lead to slower investment, reduced hiring, and weaker productivity growth. None of this constitutes a crisis on its own, but together it changes the trajectory of the economy. Another consequence is the growing role of central banks as market participants. As private actors become more cautious, monetary authorities step in more frequently to provide liquidity and stabilize prices. This expands their influence over asset valuations and credit conditions. The financial system becomes more centralized, with policy decisions playing an increasingly direct role in market outcomes. Such centralization has trade-offs. It can prevent disorderly collapse, but it also reduces the market's ability to allocate capital based on fundamental signals. Mispricing can persist. Inefficient firms can survive longer than they otherwise would. Over time, this can dampen innovation and productivity. The persistence of these signals also affects public trust. When people perceive that financial markets are being propped up while real economic conditions feel strained, confidence in institutions can weaken. This may manifest in political polarization, regulatory backlash, or shifts in consumer behavior. The monetary system does not operate in isolation from society. Its credibility is intertwined with social and political stability. In this context, hard assets and alternative stores of value often play a greater role. Not because people expect catastrophe, but because they seek diversification from a system that feels less predictable. This gradual shift can influence everything from savings behavior to investment strategies. What emerges is a landscape of controlled instability. The system continues to function, but it does so under constant management. Adjustments become more frequent. Policy responses become more complex. The underlying structure grows more sensitive to disruption. These are not the conditions of imminent collapse. They are the conditions of a system that has entered a new phase, one where stability must be continuously engineered rather than naturally sustained. As the patterns described throughout this analysis slowly come into view, what becomes most apparent is not a single dramatic fault line, but a broad shift in how the financial system carries its own weight. The mechanisms that once absorbed stress quietly are now transmitting it more visibly across markets, institutions, and policy frameworks. This is not a statement about failure, but about transition. Central banks, for all their technical authority, are operating inside a narrower corridor than many observers realize. Their tools still function, but their effectiveness is increasingly shaped by debt levels, political constraints, and global capital flows. Each intervention carries a longer shadow, altering incentives in ways that persist well beyond the moment of action. The behavior of hard assets, including silver, reflects this evolving landscape. These instruments do not respond to headlines or narratives. They respond to balance sheets, to liquidity conditions, and to the quiet movements of capital-seeking durability. When their behavior begins to diverge from long-established patterns, it is rarely random. It is a reflection of deeper adjustments taking place beneath the surface. What matters most in such an environment is not prediction, but perception. The ability to recognize when familiar signals begin to lose clarity and when new signals begin to form becomes a form of financial literacy. Markets have always been complex, but complexity becomes more consequential when the margin for error narrows. Throughout history, periods of monetary strain have not been defined by immediate breakdowns, but by prolonged phases of adaptation. Policies shift, institutions recalibrate, and investors gradually change how they interpret risk and reward. The system evolves, not because it chooses to, but because it must. This is why attention to central bank behavior remains essential, not as a guide to short-term movements, but as a window into how the architecture of finance is being maintained under pressure. Their actions, and sometimes their hesitation, reveal more about underlying conditions than any official statement. As these signals continue to develop, they invite a more measured form of awareness, one that does not rely on urgency or fear, but on careful observation. The financial system is speaking in quieter tones now, and it requires patience to hear it. In the end, the story being told is one of resilience under strain. A system adjusting to limits it can no longer ignore. Understanding that process does not provide certainty, but it does provide context. And in a complex world, context is often the most valuable insight of all.